Perhaps the most influential statement which guides the preparation of general purpose financial reports is the Conceptual Framework Project. A conceptual framework project is an attempt to define the nature, subject, purpose, and broad content of general purpose financial reports. This definition was provided to us by McGregor, who was the research director of the Australian Accounting Research Foundation. This conception of the framework sees it as a normative theory which tells us what accounting should be. However, it is also possible for it to be viewed simply as a descriptive theory of what we presently do. I'm not particularly concerned about how we consider it here, but sufficient is to say that it is how we generally conceive accounting to be, or financial reporting to be, as accountants. There are certain benefits of having these frameworks. Hopefully it'll lead to accounting standards which are more consistent and logical, because they're developed from a common frame. To the extent that there is a comparison point, then standard setters will be more accountable. To the extent that the framework supports accounting standards, it's going to make them more understandable. And to the extent that we don't have to re-argue or re-debate fundamental issues in accounting, it's going to make accounting standard setting more economical. We've had conceptual frameworks for many, many years. In the early days, they were more descriptive, and this is probably the best way of describing the tentative statement of accounting principles, which was issued by the American Accounting Association in 1936. However, since the 1960s, they've been much more normative in terms of describing what accounting should be. We can see this in the statement which was issued by the AICPA in 1961 and 62, and in the statement issued by the Accounting Principles Board in 1970. These were probably the forerunners of the conceptual frameworks that we see today, and they were very definitely normative theories. I think it's instructive to note that these conceptual frameworks tended to be developed most in periods after crises in financial reporting. When it comes to the frameworks that we see today, it's probably fair to say that the current family of frameworks trace back to the 1970s, and the frameworks were developed by the FASB from 1978 onwards, the IASC from 1989 onwards, and the Australian Accounting Research Foundation from 1990 onwards. These frameworks are broadly consistent and they're evolutionary, and we can see that we're still following the same basic processes today that we were back then. It's also important to appreciate that what it's telling us is that accountants around the world generally have the same perception as to what financial reporting should be. Today, the frameworks are captured by the FASB's concept statements, and that's now contained in statements number 4 to 8. 1 to 3 have been superseded. The IASB framework, which was issued in 2018, and the AASB framework, which was issued in 2019. These just aren't theoretical documents, they have practical implications, and we've seen that recently with the way in which the framework defines the reporting entity, which has necessitated reconsideration of the definition of reporting entity in Australia, and that's contributed to our moving away from special purpose financial reports. The framework today consists of 8 chapters, and it's important that you read through these chapters and to see what they are trying to achieve. When you're reading through these chapters, please appreciate there is a headline statement or requirement or description, and then it's supported by a number of other paragraphs. I'll call these just supporting paragraphs for clarification. So for example, when we look at chapter 1, it describes the objective of financial reporting as providing information for decision making. But in the supporting paragraphs, you'll see that it says that we should also consider information from other sources, that a general purpose financial report is not an exercise in company valuation, and it acknowledges that there are going to be conflicts and compromise necessary due to diverse users and uses of general purpose financial reports. Chapter 2 describes the characteristics that financial reporting information should have. First and foremost, it should be relevant. And when we talk about relevance, we talk about its ability to impact decision making. That impact can be because it's predictive, confirmatory, or both, and that must be material. Faithful representation means that the information should capture the economic substance of transactions or events. It also means that the information should be free from bias, it should be complete, neutral, and free from error. Chapter 3 is probably the least developed of the chapters, and you can see here it defines the reporting entity. That's not so much of a problem. But it then goes on and talks about who should prepare reports and what are the boundaries of the entity for which reports are prepared. This is where it becomes a lot more problematic, and I do tend to find that the definitions of the reporting entity do seem a little bit circular. Chapter 4 identifies the major components of the financial statements. You'll note that we give definitional primacy to the definitions of assets and liabilities. And you can see here that we define assets as economic resources controlled by the entity as a result of past transactions. That's the major paragraph. And then in the support paragraphs, you'll see we define what a right is, what an economic benefit is, and what control represents. We go through a similar process with liabilities, defining what a liability is, and then providing support in terms of what we mean by what is a present obligation and what is a transfer of economic benefits, what is a past event. When I say we give definitional primacy to assets and liabilities, what it means is that we define other items in the financial statements having regard to those definitions. So equity is the residual interest in the entity, in the assets of the entity after deducting its liabilities. That's just a fancy way of saying equity equals assets minus liabilities. And this is pretty important because it ensures that everything appears in the balance sheet once and once only. Similarly, we define income as being increases in assets, expenses as being decreases in assets, and it excludes from the definitions of income and expenses transactions with equity holders. At the end of the day, profit or loss is income minus expenses, which is at the end of the day effectively net changes in assets and liabilities, excluding those transactions with equity holders. Recognition and derecognition is probably one of the more unusual chapters to read. It probably achieves most of its significance in relation to financial instruments, but it is here for an important reason. You have to recognize something when it meets the definition, when it's relevant and is required for faithful representation. There is some interesting discussion on how you handle the existence of uncertainty and low probability events, and how you handle measurement uncertainty. So it's an interesting chapter and one that you should read a little bit more carefully. Measurement has always been an issue in the frameworks because on the one hand we like historic cost because it's very easy to calculate and easy to audit. On the other hand, fair value or current value is a lot more problematic. So when you read chapter 6, you'll sort of see that it takes an each way bet, and it identifies that measurement is perhaps the most significant issue in accounting standard setting. We can see that historic costs can be used sometimes, current value can be used sometimes, and when we talk about current value, maybe it's fair value, which is a market value, maybe it's value in use, which is what you get from using it, or current costs, which is the cost of replacing it. An issue is that when you choose a measurement model, you need to use it consistently. When it comes to chapter 7, this is probably a bit underdone as a chapter, and if I could just refer you forward a little bit, it's maybe addressing a lot of the things that are probably addressed in IAS 1. What it's saying here is you need to present information which gives a faithful representation of information which is relevant for decision making, or in other words, just do your best. Capital, or how you measure capital, is perhaps one of the more interesting chapters from an accounting theory point of view, but not from a very practical point of view, because it defines how we measure capital. Chapter 8. And we need to appreciate that there are two ways in which we can think of capital. We can think of it in terms of financial capital or physical capital. Financial capital would suggest that we maintain a number of dollars. Physical capital would suggest that we maintain the number of assets, cars. Now, this isn't a huge issue unless you live in an inflationary environment, and that hasn't been a feature of our economic environments for a number of years now, and so we tend to have played it down. But please note that through history we've been through a number of inflationary periods, and we've experimented with alternative ways of measuring capital and adjusting capital. Constant purchasing power, which was an inflation adjusted, index adjusted basis. We have COCO, continuously contemporaneous accounting, which measured exit prices, and that was advocated by a guy called Ray Chambers. If you're interested in history, you might look him up. And we also have had CCA, current cost accounting, which focuses on entry prices. And around the world, that's been addressed in accounting standards, which didn't last very long, such as SSAP 16 in the UK, SAP 1 in Australia, and CCA 1 in New Zealand. This is just another dimension of the measurement